Hello, everyone, and welcome to Zeifmans Presents Non-Resident Digital Event Series. I'm Callie Bird, Zeifmans Marketing Manager, and this is part 2 of our series, High Net Worth Edition, Legacy, Preservation, and Optimization, presented in partnership with our NEXIA International affiliate, Fan, Fan & Co. So before we begin, just want to go over some house details. If you have any questions, I encourage you to ask them throughout in our chat box that's located in the lower left-hand corner of your screen. We will try to answer as many questions as we can at the end of the webinar. Vicki and Jonah will be staying on, and if we don't get to your questions, we will follow up with you afterwards. We will also be recording today's webinar, as well as all of the interviews that we'll be hosting on Zeifmans' Instagram channel from 11 a.m. to 12:30, which will be circulating to you within the coming days. So with that, let's begin. So today's agenda, we're going to quickly meet Fan, Fan & Co., a little introduction with Zeifmans, and our affiliated company, Tower Street Wealth. We'll also share with you a little bit about NEXIA International. Both Fan, Fan and Zeifmans belong to NEXIA International. Then we'll move into the information portion of our webinar, which will discuss high net worth individuals both entering into Canada and high net worth individuals entering into China, and then at the end, the Q&A. So a little bit about Fan, Fan & Co. So established in 1976, Fan, Fan & Co. Limited is a certified public accountancy practice with headquarters located both in Hong Kong and mainland China. Fan, Fan & Co. provides services to 1,000 plus clients, including publicly listed and private companies. Their services include audits, taxation, and various corporate services. Fan is a member of NEXIA International, a top 10 global network of accounting and consulting firms. Through the NEXIA network, Fan, Fan & Co. can deliver cross-border services and provide effective global solutions. And a little bit about Zeifmans. We're a full-service tax accounting and consulting firm based in Toronto, Canada. We're one of the top 20 largest Canadian firms in Canada by revenue. We have 18 partners, a team of 150 plus staff, and over 9,000 clients. Our services include business advisory, valuation, corporate finance, transaction services, corporate turnaround, and insolvency and estate and succession planning. For 60 plus years, our experience in developing innovative financial and tax accounting solutions has been driven by our creative insights to help guide entrepreneurs. I would also like to tell you a little bit about Tower Street Wealth, which is one of our Zeifmans affiliated companies. It's for most ultra-high net worth individuals. The journey is powered by sophisticated strategy, aggressive decision-making, calculated risk, and meticulous attention to detail. Protecting and enhancing your wealth for the future will require the same level of high-touch proficiency that we're here to help. Launched in November 2019, so we're just a year old. I believe almost as of this week. Tower Street Wealth works with you and your family as a financial advisor, developing innovative, tailor-made financial strategies to preserve and enhance the wealth of your family and legacies to come. And a little bit about NEXIA International. As I mentioned in the beginning, both Zeifmans and Fan & Co. are members of NEXIA International. It's one of the top 10 global networks of accounting and consulting firms in the world. There's 700 plus offices, 3,400 global partners. We're in 120 plus countries, and it's ranked again as one of the top 10 global accounting firms in the world. For 25 plus years, NEXIA International has ensured that all member firms meet and maintain high quality control standards. If you're ever looking for an opportunity to expand or maybe look at new ways to grow your business, this is a really great connection to have. So before Vicki takes over and walks you through her portion of the presentation, I would like to quickly introduce Vicki. After working with her for the past few weeks on this, she is fantastic, and I can't say enough great things about her. She's a managing partner of Fan, Fan & Co. Vicki oversees the tax, audit, and advisory departments in Hong Kong and Greater China. She focuses on serving major clients in manufacturing, trade, investment, and service sectors. With over 20 years of experience in IFRS audits, financial and tax due diligence review, tax investigation, and corporate advisory, Vicky is the Divisional Counselor of CPA Australia Greater China Region and the co-chairperson of Public Practice Committee and chairperson of its Women in Leadership Committee. And with that, Vicky, welcome to the stage.
Many thanks for Kelly's introduction. Good morning and also good afternoon to you all, for our friends and clients in Hong Kong and Asia. It's really my pleasure to join Zeifmans' non-resident digital event series today. And my agenda for today will be covering the topics of as below. Why investing in China? What would be China's development focus? Setting up enterprises in China. And I'll also walk through taxation relating to these wholly foreign-owned enterprises and the tax implications for expatriates. And lastly, I'll also briefly talk about how individuals or corporations investing in real estate property in China. So why should we invest in China? Here is a summary of the statistics about China. According to the World Bank, China is the second largest economy in the world. So we're behind the United States, number one, but we're ahead of Japan, which is number 3. And according to UNCTAD World Investment Report, China was the second largest recipient of FDI inflows. FDI refers to foreign direct investment, and the amount of FDI inflows amounted to $141 billion, and it was in 2019. And also last year, China was the 4th largest source of outward FDI flows, with the amount of $117 billion, and the ranking was up from the 11th in more than a decade ago. And we look at how the World Trade Organization, WTO, talked about China. China was the world's largest exporter of merchandise trade in 2019 and reaching $2.5 trillion. And the ranking was going up from the 11th in 1995. And the International Monetary Fund also gave the statistics of China having the largest foreign currency reserves. So as at end of December last year, the foreign currency reserves reached $3,108 billion. Some more statistics for you. Last year in 2019, regarding exports and imports in China, the total value of Chinese exports amounted to almost $2.5 trillion, and the total value of Chinese imports amounted to $2.076 trillion. So nothing of the Chinese exports and imports, China had a trade surplus of $421 billion. So when we look ahead, you can see that actually the sources from Bloomberg conducted this very interesting analysis. And on the left-hand side, we can see the likely post-pandemic growth in 2021. There are 15 economies forecast to account for 74% of the global economic growth for next year, with the forecast of China having the biggest share of increase of world GDP. And what happens in 5 years' time? So you can see on the right-hand side, we can also see China is predicted to be the biggest contributor of global GDP growth in 2025. So now I'd like to share about some of China's development focus in the coming years with you. As you might know, China is often called as a socialist market economy. So many businesses are still greatly influenced by Chinese government policies. So therefore, it is important, I think, to understand what is coming next from the government strategy. The Chinese government has recently announced its development targets for the 14th five-year plan, which is covering the next 5 years ending 2025. And these targets are as follows. Number one, make new strides in economic development. Take new steps in reform and opening up. So we can see China wishes to further improve its socialist market economy, and it aims to build a higher standard of market system. And it also aims to further enhance social etiquette and civility with the core socialist values to be embraced by the Chinese people. We also like to make new progress in improving environment, reach a new level for the well-being of the people, and further enhance governance capacity. And in achieving these targets, there are two main focuses. One is innovation, and another is a concept that was recently introduced by President Xi, the dual circulation. Dual circulation is defined as a policy that takes the domestic market as the mainstay, while letting internal and external markets boost each other. I think this is important for investors to note, as we expect that the Chinese economy to be shifted from an export and investment-driven one towards the economy with more focus on the domestic demand. So this might result in more establishments in mainland China in the coming years, which I'll talk about later on the corporation setup and also on some of the relevant taxes. So next, I would like to share with you about Greater Bay Area, which is also a key focus of China's development in recent years. Perhaps it's better to go for the picture. So Greater Bay Area brings together 11 cities, including 9 cities in Guangdong province, the southern part of China, and 2 special administrative regions of Hong Kong and Macau. The area covers 56,000 square kilometers, which is about 3 times the size of the San Francisco Bay Area. And we have a combined population of over 72 million people and GDP of around $1,600 billion. I actually live in Hong Kong, the orange part of this map. And we're in a unique position that as a special administrative region, we're having the one country, two systems here in Hong Kong. So our economic and administrative systems are independent and different from mainland China. With this combination of Guangdong cities and these special administrative regions, Greater Bay Area aims to leverage the collective strength of the region through coordinated economic development. And again, innovation and technology is the key focus of Greater Bay Area development. So now I move to the topic of setting up enterprises in China. There are several options available to foreign businesses who wish to set up a new legal entity in China. Of course, I have to stress that the incorporation option that is appropriate for you really depends on the nature of business you're planning for, which business relationships you might have and you may need to protect, and what are the business activities and where they will be carried out. So these common business structures are wholly foreign-owned enterprise, and I'll go through them, maybe I'll just go through them one by one. So in short form, it's called WFOE, WOFE. It's the most common type of business entity in China, being 100% owned by foreign businesses. And this structure is available for most industries, including manufacturing operations, investment in other companies, and trading of goods and provision of services. We also have joint venture, which is the structure for the combination of local business and foreign business. It's often used when a government has provided certain restrictions on foreign ownership in an industry, such as the automotive industry, tobacco products, and legal consulting services. And it's often good to use joint venture when the foreign businesses might wish to benefit from the knowledge of a local expert or to leverage the existing network of the local businesses. Representative office. It is not the common choice of entity setup in Hong Kong, because this type of office is only allowed to engage in limited business activities such as market research activities and liaison office services for headquarters, and it cannot engage in productive or profit-generating activity. So lastly, we have branch office. Branch office in China is registered for the existing WOFE, the wholly foreign-owned enterprise, or the joint venture. So it is normally disallowed to be established by a foreign company outside of China. A common question often asked by my client would be whether a wholly foreign-owned enterprise, a WOFE, or a representative office should be set up. So in this table, we summarize the major differences of this setup for your reference. So you can see there's no capital requirement for the representative office, but whereas there's minimum capital requirement for a WOFE. But due to a recent company law changes, there is now no requirement for fully paid up capital. So a foreign company can actually just start the incorporation process with a basic capital injection that is sufficient to run the business initially. And for the company setup time, this is just a rough estimate that our representative office might take 1 to 2 months of the setup time, and for WOFE, it might be 2 or up to 3 months. And for taxes, because the representative office is prohibited from earning income from China, so the tax is actually only taxed on the operating cost. So there's no income or profit for taxation purposes. And for WOFE, it's taxed on the actual revenue, the profit derived from the services or sales. For the taxation of WOFE, in a minute, I'll talk about it. And for staff employment, for representative office, there's for representative office, we cannot directly employ staff, and we have to use a labor agent, and there will be a minor fee, a small fee of about 300 monthly per head. But for WOFE, we can actually employ staff ourselves. For management purposes, the board of directors, for representative office, we only need to have 1 chief representative, but whereas for WOFE, we will have a legal representative and 2 additional directors, or not, because this is optional to have additional directors, and there will be 1 supervisor. So as mentioned, the representative office cannot derive income from China, whereas the WOFE, you can trade with the domestic customers. And for business scope, representative office is very restrictive. For WOFE, is a lot wider range, but pre-approval is still required. So I'm going to talk a little bit about the taxation relating to the WOFE. So you can see there are various types of taxes relating to the WOFE, but I'm just going to go through 2 main types, the CIT, the corporate income tax, and VAT, the value-added tax. CIT, the corporate income tax, is payable on the taxable income times the applicable tax rate. Taxable income in simple terms is the net profit after making tax adjustments. The standard rate is 25%, but there will be tax reductions or exemption on certain industries. For instance, the projects relating to environmental protection and energy or water conservation might be eligible for tax exemption. And you can see in this table that the tax rate can be as low as 5 or 10% for small companies with total assets below renminbi 50 million and with your employees below 300. And for value-added tax, VAT, The tax rate and whether this company can deduct the input VAT would actually depend on the total revenue. So if the total revenue is 5 million RMB or less, then it's considered as a small-scale taxpayer, and then you can enjoy the 3% VAT rate. The general taxpayer would be subject to a higher tax rate, but it can offset the taxes by the input VAT, which is the VAT that is paid to the supplier. And you can also see that the small-scale taxpayers are exempted from VAT if the monthly revenue is less than renminbi 100,000. So moving from enterprises to individuals now, we're going to explore the tax implications for individuals entering China. The first question we have to ask is, how is an individual defined as a tax resident of China? A tax resident is someone who has a domicile in China or who does not have a domicile in China but has resided in China for 183 days or more in a tax year in China, which is also the calendar year. And a non-tax resident is just the opposite. No domicile in China and has only resided in China for less than 183 days. So what does this mean to the taxation impact? So when we look at this slide, it's the second question, whether your income is taxable in China or not. So in here, we look at how the China source income and foreign source income are taxed for non-tax residents and tax residents. For non-tax residents, it does make a difference for your actual duration of stay in China in a calendar year. Because if you're only staying for less than 90 days, then you're only taxed on the China source income, which is paid in China. If you stay in China for more than 90 days, then you are taxed on all the China source income, no matter where it is paid. So for non-tax residents, all the foreign source income is tax exempted. And let's look at the right-hand side. For tax residents, you can already expect that all your China source income would be taxable. But if you live in China for less than 6 years, your foreign source income that is paid in overseas will be tax exempted. And on the contrary, for the individuals living in China for more than 6 years, you'll be subject to taxation on your worldwide income. And for residents having domicile in China, that is China is your hometown, you'll also be taxed on the worldwide income. Let's look at a hypothetical case here. We have James, who is a British, who is assigned to work as a GM in the Shenzhen subsidiary of a Hong Kong company. His monthly income is composed of renminbi 20,000 payable by the Shenzhen subsidiary and Hong Kong dollar 60,000 payable by the Hong Kong company. So one scenario is if James has no single departure from China for more than 30 days, or no cumulative departures of more than 90 days in a calendar year, then you can see that all his income, both received in China and Hong Kong, is taxable. But if James travels to Hong Kong every weekend, then the tax treatment can be different depending on the timing of his travel during the week. So looking at these two right-hand side columns, if James arrives in Shenzhen on every Monday morning, let's say, and then returns to Hong Kong on every Friday afternoon, then because essentially only the full days that you're in Shenzhen are counted as the effective days of presence for tax purposes. So you can see that if we do the calculation, 52 weeks times the 3 days, the 3 full days per week in Shenzhen is 156 days. So which is less than the 183 days rule. So the result of his tax liability will be only the 20,000 RMB received from the Shenzhen subsidiary would be taxable. And the 60,000 Hong Kong dollars foreign sourced, which is paid overseas. Hong Kong is also regarded overseas for tax purposes. These amounts will be exempted. But whereas we look at the situation that if James decides to only come back to Shenzhen every Sunday afternoon and then go back to Hong Kong on Saturday morning, so it's just a very short stay in Hong Kong, then the effective days of presence of the year would actually turn out to be 260 days. And the result of tax liability in China would be 20,000 RMB taxable plus the 60,000 from Hong Kong would be actually liable to tax in the proportion to the number of days that he stays in mainland China. So there are some additional points to note. This 6-year residency rule that we've already talked about, we will actually need to be aware of this timing to avoid having to be taxed on a worldwide income. So some expatriates would exit China once every 6 years, but that exit period must be more than 31 consecutive days, so that they would be exempted from the foreign source income which is paid overseas. There are also quite a number of tax concessions for expatriates for the moment, which include the rent of accommodation, meals and laundry, relocation, language training, children's education expense in China, and the home leave travel. My last topic for today is on investing in real estate property in China. For an individual buying property in China, there are generally 2 requirements. Number 1, the individual has to have lived or worked in China for at least 1 year. And number 2, the current requirement is that the individual is allowed to purchase 1 property for personal use, that is only for your own living. So it's actually not for investment purposes, and you cannot rent out the property for rental income. Here are the tax implications for the individuals holding the property. So I'm not going to go through in details, but you can see that upon selling the property, the transfer gain will be taxed at 20%. So this slide is showing the requirements for buying the property via enterprises. Because of this restriction for individuals' investment in real estate, it's common for our clients to invest the property via enterprises. So basically, the property investment holding company should have the minimum registered capital of at least RMB 1 million. And this may even vary by city in China. And depending on the total investment of the property, which is number 2 in this slide, there's a requirement on the registered capital being a significant portion of the total investment. So for instance, for a total investment of, say, $5 million, the registered capital has to be at least 50%, so that is $2.5 million for this company. There are also some formalities to follow before the incorporation of the company, as mentioned in number 3 here, that the land use rights have to be obtained, or you have to reach the land purchase agreement with your landowner or the developer. So this is a table of the tax implications for the enterprises relating to real estate investment. You'll find that the taxes are almost identical to those taxes applicable to individuals who are holding the property, except for the gains on disposal of property, which will be subject to a tax rate of 25% for corporate income tax. So this comes to the end of my presentation. Thank you very much. And if you have any questions, you're welcome to put your questions in the chat box, and we'll come back in the Q&A session. So I'll now pass my time to Kelly.
Thank you, Vicki. And with that, we are now moving to the Zeifmans portion of the presentation, high net worth individuals entering into Canada, presented by Zeifmans partner and co-managing director of Tower Street Wealth, Jonah Binder. So I'd like to quickly introduce Jonah for those of you who do not know him. Jonah is a member of the tax group at Zeifmans, and again, as I stated, the co-managing director of Zeifmans affiliated company, Tower Street Wealth. His specialization is in Canadian and international tax estate planning, tax minimization strategies, and corporate reorganization. Jonah has extensive experience assisting and advising both foreign entities doing business in Canada and real estate investment companies. In addition to his tax expertise and experience, Jonah has extensive experience in auditing and accounting for small to medium-sized businesses. And with that, welcome, Jonah.
Thank you, Kelly, for that nice introduction. I hope I can, do the same justice that Vicki did. It was a fantastic presentation. So I'll jump right into it. In terms of what we're going to be covering, it's primarily going to be about inbound planning. Zeifmans, we do have a lot of expertise with both inbound and outbound planning. Outbound refers to Canadians investing outside of Canada. And while this presentation is focused on inbound, happy to discuss offline any outbound situations, or if anyone has any specific kind of questions on inbound planning, not in the China-Canada context, happy to discuss that as well. So we're going to be covering off a bunch of different topics. First, we're going to jump into the taxation of non-residents in Canada, how new immigrants are taxed, part-year taxation. We're going to talk about residency, impact of immigrants owning foreign corporations or foreign investments when they do come to Canada, what the tax consequences of immigrating to Canada are. We'll also speak about, in general, non-residents who do not become residents of Canada but are looking to invest into Canada, as well as what it looks like when you're carrying on business in Canada and what the tax consequences of that is. We'll also touch briefly on taxable Canadian property and more specifically Canadian real estate. So the Canadian tax system taxes based on residency. That's the key criteria. Not every country in the world taxes on residency. For example, the U.S. taxes based on citizenship. So U.S. is more so different than typical. Typically, it is based on residency rather citizenship. So Canada falls into that. Non-residents are specifically taxed in Canada only on certain types of income. Those can be under the Income Tax Act and the treaty, depending on if the country that the investor is investing from has a treaty. The treaty can actually override the Income Tax Act. So Canada basically taxes three different types of income from non-residents. And that's employment income in Canada, sale of Canadian TCP or taxable Canadian property. That generally is Canadian real estate, and business income carried on in Canada. And we'll talk about in more detail specifically what carrying on business is versus how certain tax treaties will override that to have this concept of permanent establishment. So this is really to give an example of just how complex cross-border matters can be. So you take a fairly simple situation. You have Mr. Chen and his wife. They have children, Chinese citizens, and they immigrated from China to Canada. So right away, most people would jump up and say, oh, they're Canadian tax residents. But Mr. Chen has real estate investments and has a business in China. So he's actually very often in China. Again, that more facts would need to be known. How much time is he in China versus how much time is he in Canada? But Mr. Chan's wife and children, they're in Canada. So you have, and you're seeing it more and more in today's world, where, spouses might not be in the same country. And Mr. Chan's wife owns a home in Canada. Again, it's Mr. Chan's wife, not him, so that's another factor to consider. And Mr. Chan visits his wife and children in Canada on an occasional basis. Again, an entire discussion just on what's that mean, occasional. Is it he's here 30 days? Is it 30 days consecutive? When he is here, where's he staying? What's he doing? So these are a number of factors that really have to be taken into account. So to answer the kind of, so to speak, simple question of where is Mr. Chan resident, extremely difficult to say just based on this. Really, it would be a fact-finding exercise of figuring out all the specifics to do with this situation, and then really kind of forming a position. So the kind of, from an accountant side, the joke is really, where does he want to be resident? And the facts can really lend to either situation. It can be a very, quote unquote gray area. So it's extremely not straightforward and really depend on specific facts. And the purpose of that example is really just to show just overall how complex it can be. So in terms of taxation of new immigrants, life would be simple if somebody immigrated to Canada on January 1st, definitely from a tax reporting standpoint. But when a person does immigrate to Canada, which is a question of fact on what date they actually become a resident of Canada, is it the date they landed, in Canada? Is it if they came initially to visit, check out the place, and they went back home, and then they came back a second time? Is that the time if the family members come to Canada and they reside here, but one of the spouses goes back to settle and sell the home back in their former country of residence? Is that the time? Is it the sale? So again, a lot of questions of fact. There's case law surrounding all of this, but it's extremely not straightforward. When you do become a part of your residence, you get access to tax credits. There are special filing exemptions. So if you have foreign property, a form T1135 or T1134 would be required. Non-residents in their immigration year are not required to file those forms. It's also important to note that you get a stepped-up basis when you do become a resident of Canada. So a lot of planning can be done around that depending on the country where they're coming from. If the tax system there is, let's say, for example, in non-tax jurisdiction, you would want the highest value that you possibly could achieve when you come into Canada so that you have that stepped-up basis. That would mean a lower tax when you eventually sell that asset, or it can mean a higher depreciation and other certain nuances. So it really will, though, depend on a question of fact where they're coming from. So say, for example, if a person was coming from the U.S., where U.S. tax is based on citizenship, it might not make sense to trigger this gain when you come to Canada, since either way you're still taxed in the U.S. on this basis. And it's just important to also note that Canada tax is based on worldwide income. Taxes their residents based on worldwide income. So if you're a resident of Canada, anything you earn anywhere in the world is taxed in Canada. So this is a little quote from a tax court case, Garon family, and it basically explains how key and how complex residency really is, and that the key criteria for tax is residency. And as you can see, Charlotte J says here, it's a question of fact, and you really have to give full consideration to all of the relevant facts. So again, just really this is to highlight the absolute complexity that can be involved in these. In some cases it can be fairly straightforward, but generally, especially in high net worth situations, it can be extremely and exceedingly complex. So certain countries that Canada has a tax treaty with, the tax treaty will actually be able to override certain rules found in the Canadian Income Tax Act. So it's very important, and it requires more consideration to be given to the country where someone is coming from. And the tax treaty can actually override certain deeming rules found in the Act. For example, there's a common notion that if you're in Canada for over 183 days, you're deemed to be a resident of Canada. But the treaty between Canada and the other country can actually override that. So it is theoretically possible to be in Canada, say 200 days of the year, and not be a resident as a result of the treaty. Comparing that to a non-treaty country, for example, let's say British Virgin Islands, it is possible to actually be a resident in both countries because there's no tiebreaker rule found in. There's no treaty, so there's no tiebreaker rule. You would be actually able to be resident in both places. The impact of that would be nothing, since British Virgin Islands doesn't impose a tax, so there's no real bearing. Generally, countries that Canada doesn't have a treaty with are quote unquote tax havens. So typically, it wouldn't have a major impact on situations. But what the tax treaty does typically contain is a tiebreaker rule. What that does is it forces one country, forces the person to be resident in one country, so you don't have the situation of dual taxation. And then there's a part of the Act that basically, without this part, subsection 255, the treaty could apply, but the Act wouldn't respect it. So what this section does is pretty much enables the treaty to override the Income Tax Act. So the tiebreaker rules typically look at a number of factors. So these are cases where, like in the example with Mr. Chan, you would look to the treaty to determine where exactly he is resident. Since you're not relying on the Income Tax Act, which has a certain set of rules, the 183 days, etc., you're really looking into this question of fact. And the tiebreaker rules typically have different criteria, and they typically revolve around these three. These three are typically what it all comes down to, and that's the home, the habitual abode, and the center of vital interest. And there was actually a recent case that went through this. Basically, you had a situation where someone was trying to take the position that they were not a resident of Canada. And the court actually found in that case that they were a resident of Canada based on these key criteria. It really came down to the habitual abode and the center of vital interest. And it was that this individual, his connection kind of in the world, so to speak, was stronger in Canada than it was in this other place. So it really comes down to a lot of these factors. There are secondary factors to consider, such as banking relationships, health care, things like that. But in the case of Mr. Chan, for example, if his wife, his children are here, it's very difficult to take the position that he is not a resident of Canada. You would have to really look to those factors of, it would have to be much more clear that he is not a resident of Canada. And that is possible. For example, if the facts allowed for it, say, for example, he actually had, say he had a first marriage and he had children from that marriage. They were, in China. Say, his parents, his family, were also there. Say he spent more time. So those facts can really lend to being a resident of China rather than Canada. But typically, if your family, your children, your spouse are in Canada, Canada would try to assert that you are a resident of Canada due to these factors. So in terms of kind of taking this all to a step further and the complexities that can happen. So again, without going into so much detail, if you have somebody who, say for example, Mr. Chan, he had a company in China when he comes to Canada. So that would be a foreign corporation under the Act. And Canada basically has a system in place. It's called Foreign Accrual Property Income, or FAPI, which tries to not allow income to be taxed outside of, to not be taxed outside of Canada. It's to defer the ability to put investments offshore and not pay tax in Canada. So they're a very complex topic, and we could have a whole discussion just on these alone. But it's important to note that once, for Mr. Chan's example, he becomes a resident of Canada, if he does have a foreign corporation, it is subject to these rules. So you would have a filing of a T1134, and to the extent, though, that it is an active business, there are exemptions in place. So you would not be having this FAPI tax in Canada. If it is a passive business, and passive doesn't always mean actually passive. For example, certain real estate businesses, even if they are fairly active, can be considered to be passive, in which case FAPI would apply. And essentially what happens is, to the extent that you have a tax rate of approximately lower than 25%, on an accrual basis, that income would be included in Canada. This slide says more than 10%, but it's actually more than 50%. Would require it to be a controlled foreign affiliate and be subject to the FAPI regime. Without that, once you have over more than 10%, you have something called a foreign affiliate, which only results in certain surplus pools being applicable, which pretty much allow, if this was an active business, for foreign dividends to be repatriated to Canada on a non-taxable basis, assuming it's coming into a Canadian corporation. And residency is also a question of fact for foreign companies. So, in Mr. Chan's example, if it's important that the country remains a non-resident of Canada, you want to consider having non-resident directors of Canada. Perhaps if Mr. Chan remains as a director, he should be exercising that directorship while he is outside of Canada. So there's a lot of key criteria there. Again, this is really just a kind of comment just to make sure everyone's aware of it, but it doesn't, it's extremely complex. So it's also important to note that, if you have portfolio investments that are held offshore, they might not be specifically held in a corporation, in which case FAPI would apply. You do have this section of the Act 94.1, which can apply to basically if you have investments in offshore investments. So one of the main reasons, though, for holding this has to be to arrive to get a tax benefit. So again, it's a question of fact. For example, if this investment opportunity is not available in Canada, so you're forced to invest in an offshore entity, you might be able to get there. The problem really is that the wording of this section is that it's one of the main purposes. So, there's jurisprudence on this that basically can say that you can have more than one main purpose. So it would really need to be very clear. It kind of comes down to, if you didn't have that tax benefit, would you be investing there? We have a lot of expertise in this area, and it's not always a negative thing to be falling into these rules. The impact of falling into these rules is such that certain amounts of a notional income amount basically needs to be taxed in Canada, but it's actually can be structured in a way that you can fall into these rules, have that notional income, but still be able to achieve a significant deferral of tax. So, just because there are certain anti-avoidance rules in place doesn't mean that you can't still use them to your benefit. So what happens when you immigrate into Canada? So you're going to get a step up in your cost base. And we'll go through a kind of a crude example in a bit just to show you what that looks like. Again, just like I mentioned before, it really depends where you're coming from. Sometimes it'll make sense to trigger a capital gain before coming into Canada, so you get that stepped up basis. There's also rules that work around structuring a strategy around making sure you have basis, say, in a private company, so that you can withdraw future capital out of that company without paying, a salary or a dividend to a Canadian resident. So again, depends on the country you're coming from, but there are a whole host of different strategies and structures that work around creating basis that you'll be able to extract capital from later. And this is really just a crude example to show what that looks like, the stepped-up basis. Just to show you that, you had the shares initially, your original cost was $100 per share. You come to Canada, it's worth $150 per share. So you have this now stepped-up basis equating to $150 per share. The opposite is also true. So if the value had declined, say from that $100 down to, say, $75 and you immigrate to Canada, that is the cost base that it would be coming into Canada at. So now we're going to kind of switch gears from residency situations. This is more so for the non-resident who's looking to invest into Canada. So as I said earlier, there's three main types that non-residents are taxed on. You have your employment income, business income, and gains from taxable Canadian property, or TCP. So with respect to carrying on business, we'll get into that in a little bit, but carrying on business is the threshold set out in the Income Tax Act, but generally a tax treaty will override that to require a different level, which is generally a permanent establishment in Canada. This is really just to tell you the withholding that would apply on certain types of income. So generally, in non-treaty countries, you'd have a 25% withholding on income. So say you invested in a Canadian business pays a dividend to the non-resident, there'd be a requirement to withhold 25%. Treaty countries would override that typically on dividends down to a 15%. And in the case where you have a corporation investing into Canada, you can actually, and you have control, you can actually get that rate down to a 5%. So say, for example, you had a Hong Kong company investing into Canada. A Hong Kong company, you could repatriate the dividend from Canada to Hong Kong at a rate of 5% in certain cases. So that can be extremely attractive. There also is no withholding tax, though, on arm's length interest. So that can be a pretty attractive way of planning into Canada. There are certain rules, the thin cap rules, that can seek to stop this from, this benefit of occurring. But in the simplest case, you're really able to get a deduction in Canada, and the income pops up in that other country. So it's a question of kind of what the rate difference is. So, for example, if you're in a non-treaty country, say again British Virgin Islands, you're not paying tax, it would be extremely attractive to be able to repatriate funds using an interest deduction in Canada and having the interest income be taxed outside of Canada, and not have any withholding tax on that. So in terms of carrying on business, there's a section of the Act that basically, there's an extended definition of carrying on business, and it can be extremely broad, really. It's a very low threshold to meet. So if you consider, someone in a non-treaty country that doesn't have this permanent establishment concept overriding it, really just kind of, the sale of goods into Canada might not give rise to it, but if you're really just kind of looking for sales in Canada, the solicitation of sales, that can be carrying on a business, such a low threshold. And Canada in that case would assert taxation. It does come down to a number of, question of facts again. This is really where any treaty is very helpful, because it can override it and give a lot more concrete situations, this concept of permanent establishment. But it's just important to know that carrying on business really is a low threshold. And it should also be noted just that in terms of sales tax also has the same threshold, which is carrying on business. So even though, the income tax, the treaty can override and require the threshold of a permanent establishment, oftentimes you'll still have sales tax or HST issues. because that carrying on business definition is still applicable for sales tax and the Excise Tax Act. And a permanent establishment really makes it a significant, a lot more work is required in that case to have a Canadian taxation issue. Really, you have to have a fixed place in Canada. You could have employees. There's certain rules in terms of service income. We actually at Zeifmans have a lot of expertise in this area. So we're quite comfortable with it. So if someone has a question on it, happy to have a discussion offline about it. There is also the ability to file what's known as a treaty-based tax return. So say you are carrying on business in Canada and you want to rely on the income tax treaty between, say, China and Canada, and you're looking to the treaty to have that permanent establishment criteria override this concept of carrying on a business. So in the case of a corporation, what you would be doing on an annual basis is filing a tax return, basically claiming treaty benefit. And in that way, you're basically saying to the Canadian tax authorities, you don't have this permanent establishment, and therefore you're not taxable in Canada. Otherwise, what tends to happen is in Canada, there is basically, if you don't file this form, it's a penalty of $25 a day, so a maximum of $2,500 a year, and it's kind of low-hanging fruit for the Canada Revenue Agency to go after this. So we'll often see times where they'll just go to someone who was carrying a business in Canada and assert for the last 5 years you've been carrying on business and you didn't file this treaty-based return, and therefore essentially you're subject to this $2,500 a year requirement. So it's a low cost to have it filed, and it really you can avoid having a back and forth fight with the CRA just by kind of proactively filing this treaty-based disclosure form. So now we're going to get into taxable Canadian property, which generally is seen to be real estate. It doesn't necessarily have to be real estate. For example, if you have a private company that owns a significant amount of real estate, that in and of itself could be taxable Canadian property. Even if it sold the real estate now, it just has, let's say, cash on hand, it can still be taxable Canadian property, and that's often missed. So this is another area where Zeifmans we have a lot of expertise in. It's a lot of times not seen till the very end that you might be dealing with taxable Canadian property, which can give rise, which is discussed on the next slide more, which is this 116 clearance certificate. So when you do have taxable Canadian property that you're selling, there's a requirement to withhold 25% of the gross amount of the sale, and that actually is a liability for the purchaser. So it's a pretty costly thing to miss. And there's actually a recent case where a judge basically took this to a pretty extreme place. In the facts of the situation, the non-resident basically said that they were a resident of Canada or not a non-resident of Canada, and they had a foreign address, and pretty much all of the facts led to know that this person was a non-resident of Canada, and the purchaser basically either they didn't know or they at least they should have known that these were non-residents, and the judge actually ruled that no, you were liable for this. So even though this person asserted that they were not a non-resident of Canada, the liability still resided with the purchaser. So it's a significant thing to look out for and to know about. And what the 116 clearance certificate allows you to do is actually, instead of having to withhold 25% of the gross, you're able to withhold 25% of the net amount. So take, for example, the situation where you bought property for $100,000, it's worth $1 million now. Absent filing this 116 certificate, you would actually have to, the purchaser would have to withhold $250,000 or 25% of that gross number. Whereas, really they should be withholding 25% of that net number. My example was 900,000 wasn't the best example. If you picture, the cost base being $1 million and the purchase price being $1 million, so there's zero gain by filing the 116 clearance certificate. In that case, you actually have to remit nothing versus the $250,000 otherwise would. So it's also important to note that the 116 clearance certificate is not the final tax obligation in Canada. You actually do have to file a Canadian tax return. What is good about that, though, is oftentimes that will actually result in a refund. The reason for that is that when you do the 116 clearance certificate, it doesn't take into account certain factors, such as, if let's say it was Canadian real estate, it doesn't take into account the commission you would sell or the legal fees or the other kind of let's call them the smaller costs. When you go to file that final tax return, you actually are able to then apply those costs. So typically the gain will be a lot lower. Also, if it's an individual who's a non-resident, they're actually able to then take advantage of the marginal tax rate system in Canada. So again, you would get a refund. So again, Zeifmans, we have a lot of expertise with this. We do a fair bit of this work, both in the high net worth space, but we also actually have a fair amount of this that we do for kind of the average Joe, where say they were a resident of Canada, they had a residence or something, they left Canada, a few years later they look to go sell it. So again, something that is very important, more important for the purchasers, but definitely crucial for non-residents. And then one other thing just to kind of highlight is that while this is really a liability for the purchaser, it can have significant impacts to the non-resident. For example, if they have a mortgage, on closing, if you have to remit 25% of the gross, it's possible that you won't have sufficient cash to actually pay off the mortgage from the deal. So in that case, you'd be actually having to fork out cash not associated with the real estate. So definitely something to be mindful of as a non-resident selling Canadian real estate and for the purchaser. So what this slide does is really kind of summarizes, and then I'll be able to kind of, this is going to be my last slide, and then everyone will be probably thankful that I'm done, and hoping Vicky comes back and presents the rest. Her presentation was just stellar. So what this does is really shows you just a few different options for a non-resident investing in Canada. So, on the left side, you can see a non-resident could just directly invest into Canadian real estate. And that could be at the individual level. They get the advantage of marginal tax rates. Whereas if a non-resident uses a foreign corporation to invest in Canadian real estate, they could be subject to a Canadian branch tax filing. And that branch tax filing, you would not be getting the advantage of marginal rates. For corporate purposes, it might make sense to do this structure. And then the alternative is also you could have a foreign trust. You could actually also, this slide doesn't show it, but you could also have a partnership or a hybrid structure such as a ULC, a Canadian ULC, or in the U.S. you would have an LLC or an S corp, which can offer different taxation. It requires more kind of care and consideration because there can be adverse tax consequences. And then all the way on the right, you'll see the non-resident having foreign corporation investing into the CanCo. So what that allows is a reduced withholding rate of 5% on the distributions. This also would have the advantage of the company being a non-CCPC. And what that does is effectively on the sale of Canadian real estate, you would be instead paying the higher CCPC rate of 50.17%, which has a refundable tax element, you'd be subject to the net 26.5% from Ontario sale, which effectively means a 13.25% tax rate. And again, we have a lot of experience with the non-CCPC planning, both in this situation as well as in other situations where we try to plan into it. So happy to discuss that as well. So it really depends on the case specific. And we do have a significant amount of expertise in this area, so we can definitely assist with this. And then it's one thing just to note is that I'm mostly been talking about the sale, but the actual rental income itself, if it's a non-resident who holds the real estate is subject to a 25% withholding tax. That 25% tax is on the gross amount. So again, if you had, say that case, you have $1 million of gross rental income, and that's $250,000 that has to be remitted to the CRA. Whereas you can file certain elections to allow for a net amount of the 25% to be on the net amount of rental income. So say, again, like for example, you have $1 million of income. Say in this case you had, $900,000 of expenses. So your net rental income is actually $100,000. So you'd only have to remit to CRA, $25,000 being on the net. Whereas if you don't file this election, you're really subject to a significant amount being on the gross, which can have significant impact to cash flow, especially when you have debt in place. And so that's it for my end. I'm going to turn it now back over to Kelly, and we'll happy to chat offline if anyone has any questions on this. Thank you.
Thank you, Jonah. Thank you, Jonah. So now we are moving into our Q&A portion for today. Please feel free again to ask questions during the sec time. The chat box is located on the lower left-hand corner of your screen. Again, we'll try to answer as many questions as we can. So with that, Vicky, are you back on the line? Vicky?
Yes, I am. Yes, I am.
Perfect.
Yeah.
Perfect.
Yeah,
so,
I actually saw one question in the chat box, which will be related to my part.
Yeah, so the question for you is, what is the difference between China VAT and VAT surtax?
Thanks. Yeah, so the Chinese VAT is actually based on sales, as I mentioned earlier, and the VAT surtax is the additional tax to be paid based on the VAT payable. So it's essentially what will be the surtax payable is actually the amount of VAT payable times a rate. Yeah, so it's times the surtax rate. And this surtax rate may vary from city to city in China. But I just did a quick check. If we talk about Shenzhen, which is the city very close to Hong Kong, the surtax rate, there are three types. There will be a 7% urban maintenance and construction surtax, 3% on education overall, and 2% on local education. Yeah, so we're talking about there might be around, I think, 12% surtax on the VAT payable. VAT tax payable. Yeah. So if we look at the overall percentage, it will be a very small amount, based on the sales, because the VAT itself is already calculated based on the sales.
Perfect. So I have a question for both of you, and Jonah, we'll start with you. From, I guess, accounting and tax perspective, what would be your number one piece of advice for any, I guess, non-resident looking to invest or expand into Canada or even move to Canada? Jonah?
Sorry, could you just repeat that?
So what would be your number one piece of advice for a non-resident who is considering investing or expanding their business into Canada?
I mean, it would be more so based on kind of where they're coming from, but what I would say is really it's all about proper structuring. Planning ahead of time and having a proper structure in place can significantly save on taxes. You see it often. We'll have somebody who'll come in. We'll deal with them after they've already immigrated, and we're going, well, had we done this, wow, you could have been in such a better place. So it's really about being proactive and having that discussion before you come into Canada. Yeah.
And Vicky, to flip the same question to you from accounting and a tax perspective,
sure.
Pardon?
Yeah, I would firstly, of course, like to echo, what Jonah has said. I think a very good planning is utmost important. So as we're trying to see, what we're going to achieve in the country that we're going to invest in, it's very important to know our current position and also to do a lot of research on the investing countries. I think culture. It's not just on the technical, accounting and tax side. It's also important to see the business relationship culture. What makes a very good investment in respect of China. Which location, which city we are going to do the setup is also very important because as you can see, even the tax rates and a lot of the how you do business varies from city to city in China. So in a way, I think, like Jonah and myself, we're very happy to help, in respect of all these foreign investment advisors.
No, totally. And for those of you, Vicki, as we were planning this, one of the questions that I had for Vicki, and I think this is maybe a good point for you to cover, Vicki, is what is the biggest difference between, I guess, operating in Hong Kong versus in mainland China?
Oh, this is a very tricky question.
I'm making it tough. Yeah.
Yeah, but of course I have to firstly declare Hong Kong, being part of China, and we also, I think, also having this very unique system of an independent, economic environment and judicial tax systems are so very different because, of the history before that Hong Kong had. So in a way, I would say, I think it's the legal system and the tax system, which would be, what I think for investors to really think about, when you looking at, Hong Kong versus China. Yeah, but in a way, I have to also say that Hong Kong and China, we are so much connected that, as you can see, the recent development of the Greater Bay Area of China actually includes Hong Kong as a major, very important city of growth. So in a way, we are, also very different, but we are also very connected with each other. So I have a lot of clients whom, when they try to set up an entity in China, they are still using Hong Kong as I would say, an intermediary. Yeah, so our corporate structure may look like a foreign investor holding a Hong Kong company, and then which in turn holds a wholly foreign-owned enterprise in China. Yeah, so I think that still creates a lot of benefit and the flexibility for the investors.
Perfect. And with that, we'll wrap things up and we'll start with our closing thoughts. So Jonah, why don't you go first? What are your closing thoughts for everyone today?
I would just say, to reiterate on that prior point, just really proper planning can allow for significant savings and less of a headache down the road. Including comments is that Vicki's presentation was very good.
And Vicki, same to you. What are your closing thoughts for everyone today?
Oh, that's just my big thank you to everyone first, for staying with us and for listening to this webinar. And I think my, closing word for the day would be, to let you really want to emphasize again that China really welcomes foreign investments, whether it is a company or a talent, as an individual coming in China. This is really very welcome. You can see that over the years, the policy changes, the tax concessions offered by the Chinese government are great proofs that we really welcome foreign investors.
Perfect. So with that, everyone, thank you so much for joining us today. We will be circulating this webinar, the recording of the webinar, within the coming days, as well as recordings of our upcoming interviews. So join us at starting at 11 a.m. on our Zeifmans Instagram channel. So it's at Zeifmans_LLP for live interviews. And again, thank you everyone for joining us. Have a wonderful day and or evening.